The views and opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the official position of CFA Institute.
Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wahlberg, and my guest today is Joe Klement, a CFA charter holder and managing director at Panmure Liberum, where he has responsibilities for strategy, economics, and ESG. One of the persistently original voices in our industry, Joe has spent his career challenging conventional investment narratives, especially the idea that geopolitics can't be quantified or systematically incorporated into portfolios. His work is widely read by professional investors for its clear thinking, data-driven insights, and willingness to question industry orthodoxies. And today, it turns out we have some geopolitics happening. We're going to talk about the current state of play in some key zones and look at their implications on markets. I also hope to delve more broadly into what it really means to invest in a world where politics, economics, and markets are no longer separate, and what that implies for risk, returns, and long-term asset allocation. Welcome to the show, Joe.
Well, thanks for having me, Mike.
I want to start with a look in, as I mentioned, on several of the conflicts around the world. But before we get into that, though, I wonder if you could please just describe your approach to interpreting geopolitical events in the context of investing. So what are geoeconomics?
Yeah, it's basically how do international relations and geopolitical events influence either economic development and economic growth and inflation or financial markets like stock markets, currencies, etc. Traditionally, we would have said in a narrow sense that this concerns wars, which is obviously very topical today, but it also concerns things like trade relations, tariffs, or industrial policy in order to benefit exports for other countries. So it's a wide field, and dare I say, unfortunately, it has become incredibly dominant as a driver of financial markets over the last 5 years.
Right, that's for sure. You wrote a recent paper, a white paper for CFA Institute. It was called The Geoeconomic Decade. It was a follow-up to a piece that you'd written a few years before. But in that, you said 9 out of 10 geopolitical crises don't matter, but the 10th does.
Absolutely.
Can you tell me what you mean by that? And then I'd like to go through, as I mentioned, some of those recent crises the world has been grappling with and put them to the test.
I mean, you said in your intro, absolutely spot on. I'm trying to kind of quantify something that is inherently qualitative in nature. And as an investor, rather than a foreign relations specialist, I like to think of it as kind of, do geopolitical events influence discount rates for future cash flows, for example, or expected future cash flows of stocks and bonds, etc. And this is something where I think we are in the middle of an era where tariffs and trade relations have changed the outlook on inflation. And it has changed the outlook on risk premia that we associate with global companies, because they might be exposed to policy measures in China, in the US, in Europe, somewhere else. And similarly, the war in Iran and the disturbances in the oil and natural gas market influence inflation expectations, but they also influence risk-free rates. And all of that then reverberates through stock markets, bond markets, etc.
Right. So let's start with Iran then. So how do you think about that when you read the headlines, and of course there are implications for global geopolitics, but how do you incorporate that into valuations?
Yeah, so basically I start with the point where everybody starts. I mean, I've gotten fed up with saying that 20% of global oil and natural gas flows through the Strait of Hormuz. I think everybody knows that by now.
Yeah.
So what we've done is, and what I've done is basically, I shout out to Robin Brooks of I think it's Brookings Institution. He's published on his Substack a little model to play around what the fair oil price is for different levels of supply shocks. And that gives you something like $110 per barrel oil price. And so then I basically say, okay, let's look at that oil price and let's see how that influences inflation in the US, in Asia, and in Europe. And to cut a long story short, in the US, it will, in our estimate or in my estimate, likely push inflation well above 4%. It depends, obviously, how long supplies remain disrupted. While in Europe, it will push inflation towards 2.5% and then 3% next year. That's much lower, but then again, we're also not starting at 3% like the US does. We're starting below 2% in Europe at the moment in terms of inflation. So you basically add a percentage point in inflation for the next 12 months. And then the question is, well, how does that change your discount rates? How does that change your expected cash flows? And if you're investing in oil and gas stocks, you're very happy about that.
And how will central banks respond?
Absolutely. How will the Fed respond? How will the ECB respond? And that is really the difficult question because, going into this war, people expected, and I expected that too, the Fed to cut interest rates in the second half of this year. Now they're expecting the Fed to stay on hold, maybe cut interest rates. I'm still personally quite optimistic that the Fed will cut interest rates, but only if the situation in Iran is resolved relatively quickly, and we're not going to sit here in kind of summer, autumn after the driving season in the US and still have a closed Strait of Hormuz.
So one of the themes you talk about in that most recent paper is this idea that geopolitical shocks historically are oftentimes it's a one-time shock. Markets respond,
Mhm.
and then within pick a number, 3 weeks, 3 months, whatever, it's kind of wrung itself out and moved on. Russia, Ukraine is one example that you gave where it wasn't quite that straightforward because of the links to natural gas into Europe and the risk again in that at that time for inflation within Europe. Do you see parallels here and potential risks with Iran, but on a more global scale, or how? I guess the original question is Russia, Ukraine. What did you see? What are you seeing? But I'm curious about that connective tissue there.
No, you're absolutely right. As you said, I like to say 9 out of 10 geopolitical crises don't matter because they don't change the input factors into a discounted cash flow model. They don't change inflation expectations. They don't change how central banks behave. Russia invading Ukraine was a clear example where, because of the sanctions against Russia, Europe, for example, suddenly lost 20% of its natural gas supply. And our inflation is much more driven by natural gas prices than it is by oil prices because all our electricity comes from usually natural gas plus renewables, but the price setting mechanism is through natural gas. And so that was a massive, massive shock and caused a recession in Europe and a bear market in stock markets. To me, if you had asked me 6 months ago that the Strait of Hormuz will be closed because of a war between Iran and Israel and the US on the other side, I would have said that is basically a repeat of Russia versus Ukraine. We're going to get close to double digit, if not double digit inflation. We're going to get a bear market in stocks and a recession, probably, especially in Asia, where they rely even more on uh, oil and gas from the Persian Gulf than we do in Europe, for example. And it's going to be horrendous. Yet here we are. And the one thing that I cannot figure out is why did stock markets not react more than they actually did? It is absolutely mind-boggling to me how stock markets held up so firmly. And we can kind of speculate what caused that, but it is definitely one of the things that I would have never expected. I think that the reaction in bond markets and in currency markets with the dollar strengthening and bond yields going higher, all of that makes sense to me. The stock markets don't.
Yeah, it's interesting. I mean, it's interesting that there's a divergence between those two markets because if it's an assessment of risk that this persists, you would think that they would be of one mind on that. I mean, the first thing that jumps to mind for me is just a consensus around lack of resolve on the U.S. to stick with it. That they might start a war but not persist with it, and that things may go back to normal if they were to reverse course on that. I don't know. I don't know what you think about that.
No, I agree. It's like my initial reaction when the bombs started flying, unfortunately, was that, this can't last too long because we're in election year in the US. And if gas prices go above the famous $4 per gallon and then even potentially $5 per gallon, there's a massive incentive for the US government to back out and stop this. Now we're now above $4 a gallon in the US for gas prices. And I think the market is still playing this, dare I say, tackle trend. But the problem that I have with that is, well, even if you open up the Strait of Hormuz tomorrow, oil prices will still stay elevated because by now we've destroyed a lot of the infrastructure in the Persian Gulf, both on the Iranian and in the side of Qatar, Saudi Arabia, etc. So kind of supply disruptions will remain in place for the rest of this year. And so oil prices and natural gas prices will remain elevated as well. And I somehow think that the stock market isn't really paying attention to that just yet.
Right. Yeah. And also, I mean, the length of this disruption, it's not like the oil is going to flow immediately to end markets as soon as the gates are open. It's going to take months for that oil that has been delayed to actually traverse the globe.
I mean, to give you an idea, just before I came onto this call with you, I had the wonderful headline that the IEA, the International Energy Agency, estimates that we're running out of jet fuel in about 6 weeks' time. and it takes, at least in Europe, it takes about 2 to 3 weeks to get jet fuel from the Persian Gulf, and in Asia the same, about 2 weeks. So it's like it's getting tight.
Yeah. Another thought I had around this, and you tell me what you think about this, is many people felt that the reversal on the original tariff announcements came not because the stock markets fell, but because yields backed up. And I wonder if equity markets are watching yields back up and say, okay, well, we don't really need to, again, we don't need to sort of overreact in one direction on this, because if they get high enough, then the U.S. administration will act.
I think there's definitely a lot of truth in that. I would say that what you also see and what you saw with the tariff conundrum last year was that when bond markets throw a tantrum, there is always the possibility that the Fed will have to step in with quantitative easing or some other measure to calm down bond markets. Now, I'm sitting here in London, and 4 years ago, we had our very own tantrum when we had our famous mini budget. And that derailed bond markets in the UK so much that pension funds almost went bankrupt overnight because bond yields spiked so much. And the Bank of England had to step in to basically rescue the bond market and the pension funds here. And so there's definitely that assessment that, even if the government in the US and in Washington doesn't step down, the Fed will save us because we cannot let pension funds fail. Obviously not, because I mean, then we're all doomed, basically.
Mm-hmm. How about Orban's loss in Hungary after
Mhm.
16 years in power there? What are you seeing in markets there, and what are you interpreting there?
Well, so in markets, we didn't see that much except for Hungary itself, because you have to be aware that Viktor Orban and his Fidesz party, over the last 10 years or so, he was in power for 16 years, but for some of it, he was in power with a two-thirds majority in parliament. So he changed the constitution and reduced the independence of the courts, for example.
Hmm.
And because of that, the EU blocked EU funding for Hungary. So the EU's money, which was typically before then about 3% to 5% of Hungary's GDP, and an enormous amount of jobs, that has been blocked for a couple of years now. And obviously, the big that has created a lot of economic malaise. Inflation in Hungary is higher than anywhere else in Europe, for example. And now everybody is very optimistic that under the new government, because they also now have a two-thirds majority, they will reverse some of these constitutional changes and free up EU money. And that's why Hungary is probably at this point in time for the next 2, 3 years a very, very good place to invest, because all of a sudden, a lot of the challenges that have been in place because of a lack of funding are likely to reverse.
And then finally, for this short list of global economic or global geopolitical crises, Israel is obviously part of the conflict with Iran, but the broader regional conflict there in Gaza and Lebanon.
Yeah. I mean, Interestingly, that is something where I would say this is one of those 9 out of 10 that don't matter for global stock markets or global financial markets in general. It pains me to say, but Israel is not a big economy. Lebanon is an even smaller economy. And unless you're investing and having some real estate in Israel or in Beirut, it really doesn't matter. There's no oil there. There's no economic influence there. It really is a non-show for global financial markets. That is not to minimize the humanitarian side, and I'm not taking sides when it comes to Israel versus Lebanon. It is a political quagmire where I am staying away from that. But it is, economically speaking, not relevant.
So, staying with the military theme just a little bit longer here, I want to talk about. Well, you write about Europe's rearmament
Mhm.
in your paper, which was really interesting reading. In my notes here, I wrote in parentheses Canada too, because we finally started to
Yeah.
spend on our military again up here in Canada. But
Yep. Yep.
one of the byproducts of the current U.S. administration has been renewed support for funding military spending among NATO countries. So, how important is this to economic growth, and how do you incorporate this into your valuation models?
Yeah, absolutely. And I think this is a game changer for Europe because we've become used to saying, and I'm doing whatever this is that I call my job for 27 years now. And like the one thing that I have never had to change was that Europe has slow growth and is overregulated and just everything is slow.
Mhm.
Well, that might change over the next 10 years. And it is because we, obviously, with the Russian invasion of Ukraine and then with the change of administration in the US, and we basically now realize we can't rely on the US security guarantees. And as a result, we have to prepare for a potential war with Russia. It's actually a very interesting situation in the sense that we are, if we rearm ourselves quick enough, we might deter Russian aggression towards Europe. And that's great. But if we don't rearm, we are inviting the Russians to attack either a Baltic state or some other European country,
Poland, yeah.
Poland, Finland. There's plenty to choose from.
Hmm.
And at the same time, we're not prepared to defend Europe, and we might actually lose that war. So rearmament has become an existential need for us. And that is what you see. The EU has offered up to 850 billion euros, so almost $1 trillion in loans and exemptions from their debt rules. But the really big move is in Germany and in Poland. So Poland is spending 5% of its GDP on defense already, and Germany has put in 500 billion euros, or 12% of its GDP, in additional defense spending over the next 10 years. And I just kind of read another paper from the IMF where they looked at Europe in particular of what is the economic impact of defense spending in Europe. And it is really something that creates a lot of growth. The fiscal multiplier is about 1.5, 1.5,
Wow.
saying that for every euro you spend on defense, you get about €1.50 in nominal GDP in return. So it becomes a real cash maker, a money maker also for the government in terms of tax revenues. So that to give you a number, the German Council of Economic Experts expects that over the next 5 years, German GDP will get a 6.5 to 7% GDP boost. That's almost a percentage point per year in additional growth in Germany.
Wow. And that's in stark contrast to what the experience in the US is in terms of the multiplier, right?
Absolutely. The US multiplier is much lower. And I think a lot of it has to do with the fact that Europe, rightfully so. I mean, it's like I don't agree much with Donald Trump, but I completely agree with him that we in Europe have been riding on the coattails of the Americans for the last 30, 40 years. And as a result, we don't really have a defense industry, or at least we didn't have anything until like 3 or 4 years ago. And so what you're now having is like the moment you spend more on defense, you immediately have to build new factories, hire new workers, etc. And that gives you that economic impact because you're creating an enormous amount of jobs.
And with the Readiness 2030 program as well, they're diverting more of those dollars to European suppliers.
Absolutely, yes. It becomes more domestically sourced if they can. We're obviously not going to source everything domestically, but more and more. And this is why European defense stocks have become our Magnificent Seven. I mean, I like to compare Rheinmetall, which is Germany's biggest defense contractor, and it makes the Leonard tanks and artillery and all that kind of stuff that we need in Ukraine. I mean, that's become a 10 bagger over 3 years. It's today that the share price is 10 times what it was 3 years ago. That's Nvidia territory.
Hmm. Yeah.
So yeah, we've got our Magnificent Seven as well. They're just not in tech.
Yeah. Yeah. And even though the US has its, big growth trajectory, that one of the things that surprised me in your paper was that your takeaway with that boost from the military spending and some infrastructure spending in Germany, that you saw EPS 5-year EPS growth of 7% in Europe versus 5.9 in the US. So lots of good things happening on the back of this sort of pivot.
Definitely, yeah.
So you mentioned industrial policies in your opening comments there. So tariffs obviously fall under a broader set of those initiatives. I'm wondering what should investors be considering? I guess first with tariffs. I mean, everyone's talked it to death, and we kind of don't know what what the tariff regime is going to be tomorrow. But maybe touch briefly on the impact of tariffs on net exports in the U.S., but then also beyond simple tariffs and sort of broader protectionist policy both in and outside the U.S. and with a little bit of a focus on China. So if you could talk about that.
Absolutely. So tariffs in a first step have a very basic effect. They reduce the imports because US companies that import goods from Asia, Europe, etc., will have to pay an extra tariff on it. And then usually they pass it on to end customers in the US. So what you get in the US is a little bit more inflation and you get less imports, and that should hopefully change your trade balance. And that was the ultimate goal, right? To kind of get the trade deficit in goods to decline. And we've seen that. That's exports to the US from China, from Europe have declined. But the price to pay for that is that the prices of goods that are imported in the US have increased. And that's the political decision that was made, and that's perfectly all right. I think one of the disagreements is obviously like, a trade deficit is not something that I'm particularly worried about. I think you will have a hard time finding any economist who has a problem with a country running a trade deficit, and that has also been talked to death. I think where things are getting really interesting is when it comes to dealing with China, because China obviously has a lot of policies in place that give its exporters an unfair advantage in the global market. Whether it is access to government loans at sub-market rates or outright funding from the government and kind of discounts and things like that, that is all something where industrial policy in China is creating an uneven playing field in global trade. Now, how do you react to that? There are two ways. One is the way that the Americans have done it, blanket tariffs. We just kind of don't want that stuff in here, problem solved. Well, not a fan. The other way is how the Europeans are trying to do it, which is by leveling the playing field with targeted tariffs on those goods where you can see a change. So, for example, in Europe, we've got a big car industry, as we all know, but we are being flooded with Chinese cars, in particular Chinese EVs, which typically cost 20% less than the same kind of type of EV with the same range, etc., made in Europe. So what the European Union did was put in tariffs between 12% and 38%, depending on the manufacturer, based on their assessment of how much government help they get. Perfect. I think that is the right way to do it. And it's like, it's like, we don't have a problem with you selling your stuff in Europe, but please do it in such a way that we can compete fairly. And the fun thing is, we by now, because we introduced those tariffs 2 years ago, we by now see that Chinese EVs are still 10% cheaper than European EVs. Why? Because those Chinese exporters have decided to swallow some of those tariffs in order to preserve their market advantage. But it is just a 10% gap, and the Europeans are catching up in that sense. So it is a situation where I think you use industrial policy in reaction to other countries' industrial policies, but you do it smartly in order not to hit the consumer too much.
Yeah, in a targeted way. And
Yeah.
and I guess, yeah, what you're seeing in the U.S. specifically, it's kind of a mix, right? You've got higher prices, so some inflation, higher costs for consumers, offset by, to the extent that the businesses are eating some of those tariff costs, but
Mhm.
then you've got a hit to corporate earnings. So you kind of,
Yeah, absolutely. And one of the fun statistics that I have about the US is if you look at corporate business investment in the US, um, that's gone up. It's been solid business investment growth. But if you split out tech hardware and software investments, then the rest of the economy has seen negative growth. They've invested less over the last 3 years in the US. So basically, what you see is that the entire US investment trend is driven by AI, and everybody else is suffering. And you see that also in the job market because AI and tech companies don't employ that many people. And so while the rest of the business community is suffering, you're getting kind of a declining trend in non-farm payrolls, and the job market is weak, even though the US economy is growing very nicely.
hmm, interesting. I wanted to turn just at a more broad level to talk about portfolio construction. And I'm curious if, given kind of what you know and kind of what you're seeing and the way that you're translating some of this risk into portfolios, should investors be rethinking their international diversification? How should they be thinking about asset allocation against the backdrop of understanding how these risks are persistent and influencing valuations?
Yeah, so I think definitely when it comes to portfolio allocation, the one rule is I wouldn't use a specific geopolitical event to influence my portfolio allocation because one is a temporary event, the other one is a permanent,
Right.
or at least a long-term
The one
asset
in 10.
allocation. The one in 10. However, I do think that there are some asset classes that should play a decent role, or at least a small role in any portfolio. So we've learned more and more that commodities are, at least to some extent, a good hedge against geopolitical crises. So if you still haven't gotten a commodity allocation, I think a small allocation makes sense.
What is
Not
that,
we're
like
not
two, three
talking,
percent or?
yeah, up to 5%, basically, to me. Yeah. I wouldn't put in 10% into oil or something like that, or gold for that matter. But yeah, 5% in commodities makes total sense to me. And then when it comes to international diversification, absolutely, because we are on the fundamental side, we are internationally diversifying the global economy as well. In the past, if I just take our situation in Europe and in the UK, we basically oriented our economies to the US, just like China and Japan and South Korea did. And we now realize that that can be exploited on the US side and kind of strangle us in terms of tariffs and other measures if they don't like us anymore. So what we're doing now is we're doing on the trade side what every investor is doing on the portfolio side. We're diversifying our risks. And that means that we know full well that going into bed with China and having closer relationships with a country like China is not necessarily great for you on its own. But if we kind of don't have a choice, we kind of want to have good relationships with the US, with China, with Southeast Asia, with everybody, so that if one of them doesn't like us anymore, we're not hurting as much as we did when we were basically in Europe dependent on one natural gas supplier called Russia, or at the moment, one defense supplier called the United States. So we are trying to diversify our economies. And that means that international financial markets will start to decorrelate and decouple a little bit from the US as well.
Hmm.
And you get more international diversification benefits because Europe will not just do what the Americans are doing, and Asia will not just be an annex to the US and Europe.
Yeah, it's long been said here in Canada that if the U.S. It gets the sniffles, then Canada catches the flu because we've been so tied
Absolutely.
economically and militarily and everything else with them. But there's been a big push as well up here to diversify trade partners and as I mentioned, sort of build our own military capabilities. So that's one sort of legacy of this administration. I think that it's really a positive in a way. I would say just diversifying, reducing the risk at a country or region level, for sure.
It's a fun anecdote because when I go to the US and talk to US fund managers as part of my job, the one thing they cannot understand is how we in Europe or the UK are trying to reduce our dependency on the US and instead increase our dependency on China. And they just shake their heads. And it's like,
You're trading masters, right?
exactly. It's like it's you're trading masters, which is true.
Fortunately, we're at the end of our time here, Joe. I've been speaking with you, Joe Klement, Managing Director at Panmure Liberum and author of many papers, most recently The Geoeconomic Decade for the CFA Institute Research Foundation. Thank you, Joe. It's been a real pleasure having you back on the show today. Always fun.
Thank you.
I'm Mike Wahlberg, and this has been The Enterprising Investor.